If gold was $20,000 an ounce, that would be about 5 trillion. Gold was $40,000 an ounce. That gets you about 10 trillion. He could literally wade into the treasury market with that $10 trillion windfall, which is essentially just straight money printing using the gold. We would not have to sell a single ounce of gold to do that. It's just an accounting creation gimmick.
There's really, in some ways, nothing to stop that, except this is what I think it's going to look like. Let's say that they decide to confiscate, do an overt confiscation, because they've been doing covert, but an overt confiscation when spot is at $10,000 an ounce, right? I do it globally because this is a global issue, so we need to know globally.
Yeah.
But I did it recently also just for the U.S., and instead of it being around 38,000, 40,000, whatever that number was, it was something like $135,000.
Yeah.
Global markets are entering a phase where trust in debt-based systems is being tested, and that is driving renewed interest in hard assets. Gromen and Lynette Zang explain that gold is no longer just a defensive holding. It may become central to how governments respond to mounting fiscal pressure. As debt burdens rise and bond markets become harder to stabilize, policymakers may look for alternative ways to rebuild confidence without traditional austerity. Gromen, a respected macro strategist, and Zang, known for her long-term currency analysis, outline how gold revaluation could become a major financial event. They discuss how official gold reserves, still valued on outdated accounting terms in some systems, could be repriced dramatically higher to strengthen balance sheets and create liquidity. If that happens, gold would not need to be sold physically. Instead, the higher valuation itself could inject purchasing power into the system. They also point to the growing divide between paper assets and tangible stores of value. If confidence in sovereign debt weakens further, gold and silver could attract accelerating flows from both institutions and individuals. Some scenarios discussed imply much higher gold prices over time, not because gold changed, but because currencies lost purchasing power. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Now, this is important because we still hold the gold on our balance sheet at a statutory rate of $42 an ounce that it was back in 1971. So at $4,200 an ounce, and assuming we have all the gold we say we do, which I think we probably do, but let's just keep it simple. At $4,200 an ounce on our 8,100 tons of gold, today if we revalued the gold, if Powell, Besant called up Powell and said, okay, revalue it, Treasury would have a windfall free and clear of about $1.2 trillion deposited into their checking account with which they can do whatever he wants within reason. Now, the problem is we have $27 trillion, the Treasury market's $25 trillion in debt, $37 trillion overall. I think the Treasury market is $27 trillion in size. So that's a whole 4% of the Treasury market. It's not big enough. Now, if gold was $20,000 an ounce, that would be about 5 trillion. Gold was $40,000 an ounce. That gets you about 10 trillion. He could literally wade into the treasury market with that $10 trillion windfall, which is essentially just straight money printing using the gold. We would not have to sell a single ounce of gold to do that. It's just an accounting creation gimmick. And he could buy back, $10 trillion on $27 trillion treasury market, $25 trillion treasury market. That's 40% of the market. Now our debt to GDP is not 120%, it's 80%. And oh, by the way, the monetary multiplier of printing that much money and injecting it essentially into the economy, right? Because if you own treasuries, now you got cash. You're going to spend it. GDP would probably grow 20, 30% for 2 or 3 years. Fed would have to cap rates, but the net of it would be after 2-3 years, we would have debt to GDP of probably 25%, 20%. And now the Fed can act independently, manage the monetary system, etc. Now, I think it's really important. Those numbers sound preposterous, but if you look at the market value of U.S. official gold, just the market price times our 8,100 tons, as a percentage of the foreign held portion of U.S. Treasuries outstanding, today, with the massive run we've had in gold, that is at 11%. Now, by way of comparison, in 1989, when the Berlin Wall came down, it was 20%. So gold would have to almost double just to get back to 1989 levels on that metric. The long-term average is around 40%. So gold would have to quadruple from 4,200 an ounce just to get back to the long-term average. And in 1980, when we had an honest-to-goodness dollar crisis, that percentage was 135%. So in 1980, foreigners could have brought all of their foreign debt to the U.S., demanded gold, taken gold, and we still would have had a third of our 35% of our gold left over. That is a gold bubble. Our foreign debt was 135% gold back. Today, it's 11. So now, if Besant revalued it unilaterally, he would have to make that market, I think, which is a whole lot of money creation, and that's tricky. But if they're able to pursue policies that let the market value the gold up to those numbers, for 20%, double from here, 4 times from here, and then did it, that's the market. And there are steps we could take, right? Where, there's nobody better at being a bull in a china shop than Trump, right? He can go in there and start breaking stuff, and people go, oh, God, I need gold. And if everybody bids up gold for him, they could do it. I mean, that is a way to do it fast. Yeah, I started from gold. And once you understand gold, you can get to Bitcoin. So gold is simply stored energy. That's all it is, right? It takes a bunch of energy expended to get gold out of the ground, refine it, process it, melt it, whatever. And that's all gold is. Gold is simply a store of energy in metal form. Gold isn't used for anything. People say, well, gold's not used for anything. Exactly. All it serves as a storage of energy over time as a currency unit moves around it. I've seen that argument made, and I think there's some validity to it. And that's, the gold has a small usage for that, but there's other things you can use gold for. And certainly, you can use other metals rather than gold for most of those applications. What gold's main usage is for preserving purchasing power. It is for devaluing sovereign debt or recapitalizing sovereign balance sheets after they get too much debt. And it does that because it is essentially somebody expended a whole bunch of energy to get that gold out of the ground, and here it sits. And if the price of gold gets too cheap, no one's going to expend the energy because they can't make money doing it. And so mining comes down. So gold is a store of energy. Bitcoin is a store of energy as well. It's digital, though. And the reason it is similar is because there's only, number one, Bitcoin is harder than gold, right? So when the price of gold goes up, more supply is going to come online, right? Because gold miners are going to be incented to get more. And the price and gold's supply goes up, 1% a year anyway. But it'll go up faster as the price goes up. If gold was $1 million an ounce, you'd have people out there, going out into the ocean and literally pulling the tiny bits out of the out of the ocean that sit there. But Bitcoin has a hard cap. There's only 21 million that are ever going to be mined, and that is coded into it. And that's above my pay grade for why that is, but I interact in that world, and it has been, very, very, very bright coders, et cetera. They're all saying the same thing. It's a hard cap at 21 million. Now, what a lot of people denigrate Bitcoin about, which is look how much energy it uses, that's actually, that's not a flaw. That's the feature. That is the equivalent of, basically Bitcoin's, when I say gold is a store of energy, Bitcoin is a store of energy. If you look at the price of Bitcoin over time, the amount of, the value of Bitcoin is supported by the amount of electricity it takes to create a Bitcoin. And that is essentially very similar to the amount of energy it takes to mine an ounce of gold. And the difference of Bitcoin is, number one, there is never going to be more than 21 million. Number two, the pace of mining does not change. So when Bitcoin goes from 50 to 100,000 like it did last year, it's not like the Bitcoin miners all of a sudden start mining way more gold or Bitcoin, as fast as they can. It gets the amount of mining continues to be regulated relative to the amount of mining put to the system to mine Bitcoin. And I won't get more complicated than that, but it's basically algorithmically limited based on the amount of resources being allocated to mining Bitcoin.
The deeper message is that markets may be moving toward a reset rather than a collapse. Instead of allowing a full debt deflation cycle, governments could choose controlled reflation through currency debasement and asset repricing. In that environment, holders of cash may lose purchasing power, while holders of scarce assets benefit. Gold becomes important because it sits outside the credit system. It carries no counterparty risk and has served as a reserve asset for centuries. If confidence in bonds continues to fade, capital may rotate toward metals, commodities, and productive real assets. That is why both analysts stress preparation over panic. The key issue is not timing every move, but understanding the direction of policy and protecting wealth before the crowd reacts. Let's get back to the interview.
There's really, in some ways, nothing to stop that, except this is what I think it's going to look like. Let's say that they decide to confiscate, do an overt confiscation, because they've been doing covert, but an overt confiscation when spot is at $10,000 an ounce, right? Well, where do most people in the U.S. anyway hold their gold? In IRAs, right?
Retirement account, yeah.
Retirement accounts. So what they would do is they would say, okay, look, it's your patriotic duty and we really need the gold to remain in power, blah, 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 and we'll pay you $12,000 for that gold. Well, most people believe the lies of Wall Street, and those spot contracts would go, well, wow, gold is only worth $10,000, and look at how great they are. They're willing to pay me $12.
Right. Yeah.
But that person that paid $12 million for that coin, are they turning it in for $12,000? No, they're not. That's the importance of being in that category. And again, anybody that can pay $12 million rather for 1 ounce of gold is likely to be like Treasury Secretary Wooden, who writes the laws, or who wrote the law anyway, or somebody that could influence that Treasury Secretary to write the law in their favor. When we're talking about fundamental value, we're taking a look at the level of debt versus the level of gold, and that's how we determine it. But it's extraordinarily conservative, because what that does not take into account are all the levels of leverage that are on top of that debt, plus all of the new debt that they will create in the future. So if we determine what the fundamental value is the day that you call in and set up what you need to understand that's a very conservative position. We don't know how much more debt they're going to accumulate, but the reality is desperate governments do desperate things, and that's the only tool they have is more money printing. So to be very conservative with it, that's how we determine the fundamental value. By the time you're going to execute it, what might take 10 ounces today might take an ounce at that time, because of how much, in terms of, in this country, dollars, but this is true anywhere in the world, how much more debt they've grown.
Yeah.
Because, I do it globally because this is a global issue, so we need to know globally.
Yeah.
But I did it recently also just for the U.S., and instead of it being around 38,000 to 40,000, whatever that number was, it was something like $135,000.
Yeah.
So if you're doing the calculation based on $38,000, but the true fundamental value in your country is 135, you're very, very covered in any outcome, because that's what we try and do. What if I'm right? What if I'm wrong? Let's cover both, so it just doesn't matter.
Yeah.
During that period of time, an ounce of gold had a fixed price before the confiscation of $20. A family could live with one wage earner, with the average wage being $800. We are actually getting paid less in terms of ounces of gold today than, even though the average wage, I think, is like $68,000, than we were in 1913. So a family of 4 could live quite well, and I'll, if I make a note of it, I don't think I have any pens in this drawer. Tom, can you make a note to bring the table next time, and I'll update it and I'll show you.
Yeah.
I'll show you. Or you can call up and one of the strategy specialists can also give it to you as well, right?
Yeah.
You're denying the reality of your existence. It's happening. You know, you can put it in terms of oil or tanks of gas or houses or
Right.
anything you want, because back in the day, everything was valued in terms of gold.
Yeah.
Right? And it was in the 40s that they started to shift that, so things seemed like they were valued in dollars, in terms of dollars. No. They're valued in terms of gold, which is as it should be, since that's savings-based, where you're trading labor for labor.
Right.
So understand this, okay? Number one, gold and silver in any form are monetary at its base. So anything that is marked sterling silver, my tray of forks and what have you didn't make it over here yet. But anything that's marked sterling silver or 925, so in jewelry form, picture frames, forks and spoons, doesn't really matter. That's 92.5% pure. If you have any gold, 9 carat, 14 carat, 18 carat, 22 carat is mostly what jewelry is made of. That's all recoverable. And yeah, you can start with a little bit of silver. Like I said, we have a 1 ounce minimum, and I can't really speak to some programs that we're working on, but there's always a way to accumulate. Now, in addition to that, what I'm also going to say is to learn some skills, right? Are you a good cook? Those are skills that come in really handy because, if you're living on Social Security and you're, more my age, well, maybe you don't want to go out there and haul the hay. I don't really want to do that. But what other skills can you bring to the table? Get involved with your community, right? Because inside of a community, everybody brings the gifts and the talents and what they have. So if you came into, for example, my community, right? Well, what do you bring to the table? Because quite honestly, I don't really have time to do a number of things, right? That I once had time for because I'm so busy. So hone your skills and build your community on top of that. I would really, Sarah, I cannot encourage that strongly enough.
What makes this conversation so important is that it reframes gold from a simple investment into a signal of monetary stress. When gold rises sharply against currencies, it often reflects declining trust in fiscal discipline, excessive money creation, or pressure inside the sovereign debt market. That means the next major move in gold may say more about governments than miners or jewelry demand. Lukegromen suggests that if policymakers need room to maneuver, a higher gold price could help recapitalize confidence in the system. Lynette Zang adds that ordinary savers often recognize inflation last, after essentials, housing, and insurance costs have already moved higher. By then, protecting purchasing power becomes far more difficult. If these trends continue, gold could move far beyond levels many investors currently consider realistic. Silver may also benefit as a smaller market with industrial demand and monetary appeal. The real story, however, is not just metal prices, it is the potential transfer of wealth from paper promises into tangible assets. Investors who understand that shift early may respond calmly, while others react emotionally later. Watch policy, watch debt markets, and watch real asset demand. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.